Manish Gunwani joins us, Chief Investment Officer, Equity Investments with Nippon India. Let's connect with him to understand where he feels markets are headed. Manish, good to have you back on ET Now. Thank you for joining us. A lot of yes, no, a lot of I don't know also has started when I ask people that is the worst of the fall behind us. Are you part of the yes camp, no camp, or I don't know camp? I'm giving you all the options, my friend. I'm making your life really easy on a Monday morning, not asking you to stick your neck out.
Yeah, thanks for that, Nikunj. Basically, I think, look, to be honest, I don't think we can expect supernormal return from equities in the next 1 year or so, I would think. We may get a steady return. But yeah, I mean, both from a valuation perspective, in the sense that you moved up from a very strong 18 months to the fact that there are reasonable macro challenges, both from a domestic perspective about current account deficit and inflation through commodities. And you have three big regions of the world: US, Europe, and now China. Marginally negative news everywhere, right? The US, you're seeing withdrawal of monetary and fiscal stimulus. Europe has geopolitical tension. China's got a new outbreak and they're responding very stringently against virus, which means that they're obviously compromising a bit of growth for that. So in a context where the three big regions are not firing, and valuations, given that last 2 years have been good for the market, I think we should be realistic to believe that we may get a kind of consolidation and a steady return market than expect any supernormal returns.
You still expect positive returns, Manish. That is what we're debating. I mean, nobody is talking about returns, positive supernominal returns. The debate is that whether, from the current juncture, looking at the news flow, whether it is geopolitical, inflation, Fed, liquidity, or valuation, next 12 months, will the bad get worse before it gets better? Or do you think markets are pricing in a lot of bad news? So returns will be low, but returns will be here in next 12 months.
I think return will be there. Maybe, and this is probably not a great reason, but frankly, in a world which has such high inflation, um, it's almost like saying cost of not being in equities is more than the cost of being equities, because bonds, I think, are the front line of fragility, right? I mean, given that US CPI is 7.5, everywhere inflation is 4, 5, 7%, and bond yields are the sub 2% in a lot of developed markets. I think that bond to equity switch is probably one comfort we can derive. Also from the fact that if we see India in particular, we're getting inflation after a very soft phase in the economy, maybe from a 4, 5 year perspective, which means that if you look at banks, for example, I think the reasonable bet will be asset quality will hold up pretty well, because if your underlying collateral is land or gold or whatever, that has appreciated so much in value purely because of inflation, that I would doubt if asset quality will be an issue going forward, for example. So inflation is good in for equities in terms of both EPS and in relation to bonds, how equities look. I think that will probably help equities deliver okay returns.
Manish, how does one understand the trade? Is it about pro-inflation, which is buy real estate, metals, some bit of banks because they will benefit because of inflation, or it's time to start looking on the other way? Asian Paints, Pidilite, Astral Poly, buy consumers now.
I would think it's the former for me. Of course, anyone can be wrong, right or wrong, but I just think that in that second bucket, the issue is not just inflation. As we go along during the year, you will see the Fed and ECB and Bank of England keep hiking until there is a recession, which could be next year or 2 years. We can never time that. So in a in a scenario where globally price to earning multiples of markets, I think will either be stable or come down. I don't think we can expect P multiples to be higher when bond yields are going up. I would think that it'll be difficult for very high P stocks to perform.
Good morning. This is Nantara joining in. You know, you had said a few months ago, and this is before the entire Russia-Ukrainian war, that you wouldn't go all in unless there was something about the rural economic slowdown, something was done about that. Now, of course, you know, crude oil prices have taken over. We're talking about inflation, all eyes on the FOMC. So, what to just see that, are you still not going all in? You're not taking advantage of the recent price correction, for example?
No, so when we look at domestic companies exposed to rural or let's say the bottom 50% population, I'd still be a bit cautious because the terms of trade in terms of this inflation typically hits the lower half more than the upper half, right? Because for them, the cost increase of food and fuel is a bigger part of the discretionary expenditure they have. So obviously, whatever uptrading or discretionary expenditure they were planning, they will have to spend more on basic stuff. So basically, I would look more at assets which benefit from inflation. I would look more for exporters because I'm a bit cautious on the rupee. I think versus a lot of other emerging market currencies, it's been a bit too strong. So yeah, I would probably, in terms of priority, not look too much at consumer companies at this point of time.
You'll stay away from consumer companies at this point of time. You were, of course, talking about PE ratios and margin pressures and the answer before that. What about the auto space? Because, you know, the last time we spoke, you were seeing a good risk reward ratio there when it came to the auto space, particularly the two-wheeler space.
So there is definite value there. Things have got deferred a bit, I think, because of this commodity, this thing. But yeah, from a medium-term perspective, commercial vehicles and two-wheelers specifically, I think one can have a decent exposure to that if you are patient.
How are you going to maneuver within banks right now? And the reason that I ask this is in the backdrop of the news on HDFC Bank over the weekend, the fact that RBI has lifted restrictions put on HDFC Bank's new digital initiatives. I know this is a big overhang which gets lifted. But that kept aside, within private banks specifically, do you see the underperformers, your Kotaks, your HDFC banks, to now perhaps take precedence over ICICI Bank? Or do you think the dominant position of an ICICI Bank is going to remain for the longer haul?
So in general, our preference is provided banks have a minimum quality, basically go for the lower price to book banks. Basically because between asset quality improvement and growth, we are more sure of the first one, which is asset quality improvement. Growth is still an issue. Personally, I've been a bit disappointed at the credit growth that's happening right now, because if you, not so much in nominal terms, but if you see it in context of the kind of inflation we've been having, and if you see credit in real terms, I think it is quite disappointing. Now, obviously, the hope is as the capex cycle picks up, as exports, etc., keep doing well, we should get double-digit nominal credit growth in a year or so. But as I said, given that WPI is mid-teens, CPI is somewhere around 6%, you probably should have seen higher nominal credit growth already. But again, yeah, if inflation remains strong, obviously nominal credit growth um, will remain strong. But it should have been stronger, I think, by now.
Manish, from a market perspective, how critical is continuity of top leadership? You know, today you're seeing a very sentimental move on Jubilant Foodworks, for instance. The stock is down, a good 10% as Pratik Pota stepped down. Similar is the news flow coming in from Shobha Limited as well. But, one of our experts this morning was saying that, why look at these examples? Look at Titan also. When Bhaskar Bhatt stepped down, people thought that, Titan's strong traction is going to continue to a halt, but that's not really been the case. Do you sense that the market is going to move more than this knee-jerk reaction that we are, seeing today?
Yeah, I would think so. See, a lot of these brands, a lot of these organizations are obviously institutions. And while I do think CEO is very important from a setting the culture and driving the execution perspective, um, I think that a lot of the names you took should be able to weather the storm. But also, it kind of throws light on a bit of a strange phenomena that in such a high population country, we seem to be hitting talent barriers quite fast. I mean, if you think about it, not only last 2 years, but even last 5, 7 years have not been very high growth periods for the Indian economy from a 20, 30-year perspective, right? But in spite of that relatively okay growth, it's just a bit surprising that in terms of talent, both at high and middle level, there seems to be a lot of issues. So we've seen in ID services, we're seeing it in consumer companies. I think the top down in terms of this phenomenon is a bit strange.
Migrating towards what is value and what is, in a sense, cheap. But in an environment where growth will become precious, we know that the world is headed towards, the chances of world moving towards deflation are higher. The chances of world demand coming down is higher. Don't you think the migration would be towards what is called as the safety stocks? Now, whether it is in form of IT or high P stock, I mean, wherever you're getting 10-15% growth, that will be rewarded. And we've seen that phase between 2015 to 2019 or 2016 to 2020, when the market was very polarized towards large cap stocks. Market was very polarized towards those 5-digit stocks because that was the only space where markets were confident of a 15% growth.
Yeah, Nikan, but the difference this time, I think, is for the kind of slowdown we'll probably get. No one knows what's the extent, but whatever the slowdown that may happen as fiscal and monetary policies pulled back and commodity prices being high, you're correct that logically we should see global growth taper down. Now, the question is what kind of fall in inflation will happen, and probably more importantly, the context we are having at this point of time is the central banks, especially in the Western developed economies, are significantly behind the curve, right? So in US, you're having CPI of 7.5%, and the Fed has not even started hiking rates. In that scenario, I don't think the traditional defensives will work because even if there is a slowdown and not a recession, let's assume there's a small slowdown or the growth is coming off. I think the central banks will have to keep hiking because they are so behind the curve. And in that scenario, then to expect returns from multiple expansion, and a lot of these companies are not very fast growing companies, right? So if the company is growing at 10, 12%, and if you're going to get P compression, that's the dilemma, I think, in traditional defenses. Maybe IT from a tactical perspective looks okay because, as I said, personally, I believe the rupee is bit expensive versus its terms of trade now having gone against it. And also relative to some other good emerging market currencies, it has done quite well, which makes it expensive. But the pure consumer companies facing both raw material pressure and having, these 25, 30 EV to EBITDA and 50 to 70 P, I don't see absolute risk reward. I think you have to be sure that the Fed has kind of reached the peak of hiking, or ECB or Bank of England, but I don't think we're anywhere close.
Manish, great to have you on the show. Thank you as always for taking the time out and speaking with us.